there are a lot of challenges out there for SMS investors today. Some of the more recent things have been the changes that have come in around the caps for contributions and also the fund balances, also future legislative risk. We do know that in the past, particularly over the last 10 or 20 years, there have been numerous changes to superannuation, and that leaves a lot of investors uncertain about how things are going to work in the future. Superannuation is just a tax bucket. It's a thing that was set up by the government so that you can invest your money for future retirement where the earnings are only taxed at 15% and they're taxed from within the fund. So you don't have to pay tax at your marginal rate. So if I'm on the highest marginal tax rate at 47%, obviously having money accumulating wealth at 15% is a big benefit. An investment bond is similarly a tax structure, a tax paid fund like superannuation, where investment earnings are taxed at 30%. So superannuation is a tax bucket where earnings are taxed at 15% and investment bonds at 30%, and your marginal tax rate might be as high as 47% tax. So obviously what we want to avoid is paying that higher tax rate and being able to generate wealth over a long period of time with a lower applicable tax rate. Essentially, it's just an investment vehicle where you can invest and the earnings are taxed at 30% and you have a range of investment options to choose from. So we've actually got 22 investment options within the fund, and you can switch or choose any of those investments at any time. You can start off with a minimum of $500 and just $100 a month savings. So the 30% tax rate, if your money is there for more than 10 years, you don't pay any additional tax regardless of your marginal tax rate. Now, if you pull your money out within the 10 years, you just pay the difference between 30% and your marginal tax rate. So you're no worse off than if you invested directly in the first place. With investment bonds, you can put anything you like in your first year's investment. After that, you can only put in 125% of your previous year's investment. So if I put in $10,000 year one, I can put $12,500 in year two. I can't put any more than that. But as I go through the years and I invest that additional amount, each additional amount has the same starting date as my initial investment. So I can be investing in year 9 up to 125% of the previous year's investment, and that's only got 12 months to go before I can pull it out fully tax paid. The 4 types of investors that we've identified: people over the age of 65 who may live on the North Shore of Sydney and they may sell their family home, and we know residential has been a very strong performer, and they may wish to downsize to an apartment or a smaller dwelling, and as a result they end up with a lump sum of money. They can't top that up into superannuation anymore. So where else are they going to put it? If they put it into an investment bond, they get that lower tax rate of the 30% depending on their marginal rate. They also don't have to worry about doing tax returns because the fund pays the tax for you, and the money can sit there and accumulate away, and they can nominate their beneficiaries as their children. So for that over 65 people who inherit money or downsize or come into a lump of some money, we actually have people who ring the lottery occasionally and they just want to park the money somewhere. So that's one group. The next group I'd identify is the young accumulator who's 30 years old, and that person, as I said a bit earlier, they're trying to get to 65 to access their super, which is a long way off, and we don't know what type of changes are going to occur in that period. So if they invest in an investment bond, if they go out a couple of years and decide they want to buy a new car, they can actually access their money and they're not penalised as a result of that. So it's a great long-term savings vehicle for those people, and educating them around the benefits of compound interest. The number one benefit in superannuation or an investment bond is get your money in early and let it grow for you over time. Third group we've identified is someone who's 45 and they may wish to retire at 55 or wind back. And we're seeing a lot of people doing that nowadays. And they can start up a 10-year savings plan. They've got their superannuation there till they're 65, but they might want something from when they're 55. And so those people can start out a 10-year plan to achieve that. And also they may wish to have other fees and costs on the way through. We have very high education costs nowadays in Sydney if your children are going to a private school, like 3 of my daughters. And saving for that is an important thing. You may wish to save for a holiday, you may wish to save for a couple of years off. So superannuation's there for when you're 65 and you retire, but you may have other goals on the way through, hence the name Life Goals for the product. The fourth person is a little bit more complicated, and that is with these investment bond products like Centuria LifeGoals, you can nominate beneficiaries to receive your funds on the event of your death. Now, if you were to pass away, the beneficiaries get the money paid directly by us. They don't form part of your estate and part of your will process, which can often be very complicated. So for people who have complicated families, they've got multiple marriages with multiple children, they may leave some money to the children of one marriage and not another. And also we quite often see grandparents wanting to leave money for their children. So they might want to leave money to this side of the family but not that side of the family. Via the beneficiary nomination process that we have, the money goes straight there and it isn't contested. So those four groups are probably the areas that we like to think of as perfect examples when an investment bond might be applicable. Centuria has been around for 38 years, operating as a life company, and we more recently set this product up, and the big things that we wanted to introduce in this product was some access to some of the best fund managers in Australia, and that's what the investment committee does by accessing those managers. Traditionally, the old style products would have just had a cash and a stable and a balanced and a capital guaranteed option, but now we've got a much broader menu where people can invest and get choice. So we think choice is very important. Secondly, having this product very simple is very important. You can add all sorts of bells and whistles to these products, and there are funeral plans out there and there are educational plans out there. We just believe that having a simple long-term savings vehicle is very important. You can also assign your money within this product. So I can have this fund running for 7 years. I'm 3 years away from my 10-year anniversary, and I can just give this bond to my child, or I can give this investment bond to a relative if I want to, whereas of course you can't do that with superannuation or a managed fund where there'd be capital gains consequences. So just being able to pass that money on with that assignment or transfer is a very important thing. And we're also part of the Centuria Group. Centuria Group's listed on the stock exchange. We've got a market capitalisation in excess of $400 million. It's a very big business, and having that capital behind us I think is a very important thing for investors. And more recently, we've just introduced an online application. So I don't know if you've gone through the trouble of filling out an application in hard copy, and you've got to take it to a JP to get it witnessed, and you've got to provide a photocopy of your passport. It can be quite time consuming. Nowadays with technology, you can just go to the Centuria LifeGoals website, click on the Invest Now, and you can go through an application process in about 5 or 10 minutes. We'll email you the BPay details, you can make the payment, and providing it's a fairly simple investment, sometimes when there's trusts involved investing, it can be a bit more complicated, but 9 times out of 10 it's a simple online application process. And then we also have a portal for investors where they can go to and they can look at all the information and the track record and all those previous statements that were received on the fund. So we've spent a fair bit of money on technology, and having that capability to do those online applications is a big plus. So they're just some of the things that we've introduced with the new Centuria LifeGoals product.